Oil's been on the rise after dipping below $80 a barrel just last week, but with concerns about slowing growth, how will this tug of war between tight supply and potentially weak demand play out? Joining us now for more, Hussein Allidina, head of commodities at TD Asset Management. Always a pleasure to have you here, Hussein.
Thanks for having me.
Let's start with what we heard from OPEC this week, and the drama continues to build because, of course, the White House not all that happy with OPEC did. Walk us through it.
So OPEC met yesterday in Vienna, and they announced a 2 million barrel per day production cut, which I think was larger than clearly the White House wanted, and I think a little bit larger than what the market was anticipating relative to their actual production levels. Many of these countries were not producing at the target levels. We've talked about the issues around spare capacity. The actual cut is probably in the tune of 800,000 barrels a day, which if realized is concerning given where inventories are. Inventories have drawn meaningfully over the course of, frankly, since the pandemic lows, and they continue to draw. Demand, we know, into the fourth quarter increases seasonally. We're kind of in a trough period right now where we're not driving as much, not heating as much. As we move into November and December, demand should increase there. The concern, or maybe what keeps me up at night, Greg, is obviously the macro. Depending on how bad economic growth gets, the impact that's going to have on oil demand is a concern. But ultimately, when we look at kind of balances are tight and continue to draw meaningfully.
The White House isn't happy, as we said. What can they do about it at this point? Maybe they've been tapping their strategic reserves for a while now. At some point, I have to imagine that plays itself out.
Yeah, so if we look at, the Biden administration in March of this year announced that they were going to draw the equivalent of about 1 million barrels a day out of the SPR. If we look at conventional inventories, ignore the SPR, the picture doesn't look so bad. But when you actually look at the total picture and you look at what's been coming out of the SPR, inventories are sitting at remarkably tight levels in the U.S. To your question, what could OPEC or what could Biden do? He could potentially announce a continued drawdown from the SPR, but we are getting to levels where, again, it's quite concerning. There's some discussion about relaxing sanctions on Venezuela. There was stories yesterday that came out that the White House is potentially considering relaxing sanctions on Venezuela to allow Chevron to increase production there. The truth is you're not going to be able to get a supply response immediately. So it's a bit of a pickle, frankly.
All right, you bought some great looking graphs along. We just showed the audience the U.S. inventory ones when we were talking about the strategic reserve and what they've been up to. What about production levels out of the States? I mean, if the States isn't getting the production it wants from the other side of the world, what about this side of the world?
So early this year, analyst estimates were that U.S. production was going to grow by 1 million plus barrels per day from start to finish. If you look at the chart that's up there right now, we're up 600,000 barrels a day. And again, this talks to the shortages of labor, the shortages of material, as well as the desire for many investors to not see companies grow production because of ESG issues. So again, if we look at sort of supply and demand, whether it's in the US or globally, the fundamental picture is extremely tight and continues to tighten. I think the only reason that oil is trading at $80, $85, $90 a barrel and not higher is because of this concern around what tomorrow brings. If you see a material contraction in economic activity, that is going to play into weaker oil demand. However, when we look at the history of oil demand, there's only a couple of occasions in the last 50 years where demand has declined in absolute terms, and that is around the pandemic, around the financial crisis, and then earlier in the early 80s around the Iran-Iraq war, in the mid-70s around the Arab oil embargo. If you believe in GDP growth, you have to believe that oil demand is going to increase because it is that oil that is firing that GDP. This chart, if viewers can see it, is U.S. implied oil demand. It's in the average range of where we've been for most of the year. Weaker than it was in 2019, but not capitulating. And I think without capitulation in oil demand, our inventories are headed to precariously tight levels.
Now, once you really get into the oil trade and you understand that terms like contango, backwardation start getting thrown around, walk us through this next picture. What is it showing us?
Yeah, so this is actually super, super important, I think, particularly for commodity investors. So backwardation is the term that is referred to when the forward price of whatever commodity you're looking at today, we're looking at oil, when the forward price is trading at a discount to the price today. Today, the price is trading at a premium. So notwithstanding the fact that the flat price, the price that you see on the screen, has come off from the 100 plus that we were at in the summer, the backwardation in the market has remained as pronounced. refiners, those that actually consume oil to make the end product that you and I consume, are still willing to pay a material premium to have that oil today vis-a-vis waiting till tomorrow or next month when they can get it at a discount. This underscores the tightness in the market. If inventories were not tight, if inventories were not drawing, you would see that backwardation fade and potentially move into contango. Ultimately, that backwardation has stayed as pronounced, if not more pronounced, which again underscores how tight the balance is.
All right, this last picture to show the audience, walk us through what it's showing to us, sort of something about speculative plays in the oil trade.
Yeah, so again, worried about economic activity as we head into the fourth quarter and into 2023. But if you are constructive oil like I am, the fact that that speculative length is at very low levels is encouraging. You have seen a tremendous sort of withdrawal of the market from non-commercial participants. The fact that spec length is low is, I think, encouraging, at least from my view, where I do see oil prices moving higher.
So in terms of the greater risks, we touched on some of them, obviously what OPEC recently did, how the White House is unpleased. What about the Russia situation in terms of their supplying of crude to the world?
Very good question, Greg. So if you look at what's happened, clearly Russia is sending less natural gas to Europe. But if you look at the high frequency data, Russian exports of crude oil this year have actually been higher than they are in 21. December 5th is an important date because that is when we're supposed to see sanctions on Russian crude. It hasn't happened yet. If I think about the checklist of things between now and kind of where we're heading, the Russia situation is either flat or positive for oil price because you'll either see the same amount of crude if Europe bulks and doesn't import, or you'll see less. When you look at the SPR that we talked about, those sales end conveniently around the midterms in the US. That's been 1 million barrels a day of supply that's come out of strategic reserves available to the market. That's ending. Seasonally, my demand increases as I move into the fourth quarter. We talked about that at the start. China has been largely absent from the market. This year, implied demand in China is weaker than it has been at any point since 1991. If China reopens, imagine you see incremental demand from China. So the catalysts, the list of things that are positive for oil are definitely longer than the lists that are concerning, which is, again, economic activity.